Hi everybody, this is David Kino with Basecamp Trading, and this is the free video for Wednesday, February 13th, 2019. So I want to just quick talk to you about a subject. If those of you that are familiar with me know that I used to work with the Vanguard Group's asset management for over a decade, and we would position a lot of portfolios according to our asset allocation model, which normally had our equity or stock portion of that allocation growing at the acceptable 8, 9, 10, 11, 12% per year. Okay, and this is how we came up with appropriate allocations for long-term portfolio growth. The one thing I want to bring to mind is something that came out just on the 11th. It was actually quoted by CNBC that the Chief Investment Officer, Greg Davis, for the Vanguard Group, dramatically cut the expected rate of return for the stock market. His quote was, "If we look forward to the next 10 years, our expectation around U.S. equity markets is about 5% median annualized return," he told CNBC. 5 years ago, we would have had that number somewhere around 8%. Now, you know that Vanguard, being the largest mutual fund company in the world, it's got about $5.4 trillion under management. And by its nature, because it's we do a lot of index fund trading, we know what to expect from the markets, okay? And for us to go from 8% down to 5%, you are losing a significant amount of potential growth in your stock portion over the next 10 years. I bring this to mind because a lot of traders have benefited from the bull market that we've been experiencing from the past 10, 15 years, even with the way the markets moved in 2008. Okay, we've generally still been bullish. So for Vanguard, which is a very conservative outfit, to come out and dramatically reduce that stock portion growth to 5%. I mean, that's almost the equivalent to U.S. bonds now. Where are you going to get your growth? Okay? And you experienced some of that last year when you're happily moving along in the S&P 500, and right around here, end of September into October, this is your gain for the year because this is the previous year's close. So anything above this line is a gain for the year. In the course of the next 20 days, okay, from 10/3 to 10/24, in the next 20 days, we lose all the gains for the entire year. And by the end of the year, right here, we actually end up negative on the year. Okay? What I foresee is a lot of sideways price movements, if not for at least the beginning of this year, and then possibly a sell-off going into the end of 2019 into 2020, because that's when Ray Dalio says that's about the right time for a recession, according to the short-term debt cycle. Okay, so that's what we're looking at. The question is, where are you going to get your growth from? So keep those things in mind, because you, as an individual trader, being able to take advantage of different time frames, and with your ability to take long and short position, if you have a sound strategy like 11-hour options, you can dramatically exceed this type of meager return year after year after year. Or you could just leave it up to the markets and go pretty much nowhere fast. So keep that in mind. Best of luck trading, and just let you know, Basecamp Trading is here for you in case you want to learn how to trade on your own. Thanks a lot.